The market, unlike us, or me anyway, was in a pretty calm ride for most of last year. We had solid gains in 2019. We had almost no big down days. And this year started kind of the same. Look at that chart. Then February 20th hit. And so did the volatility. Multi-100-point down days, a big losing streak of more than a week, then a 1,000-point gain on Monday, a drop yesterday, and another 1,000-point gain today. Got a good stat put on the Twitter from Trading Nation guest Eddie Elfenbein. This was the S&P 500's third daily move of up or down 4% in the last week. In the 8 years before that, there were two total, 3 in a week, 2 in the previous 8 years. Let's talk more about the big market swings, maybe how you can navigate them. Joining us is Amanda Agati, PNC Financial's chief market strategist. No doubt listening to us talk and thinking I want to jump in and say, Amanda, what?
Well, I definitely agree with the move today being largely a function of, as you said, the Biden bounce. We had been coming into this year talking a lot with our clients about the volatility around the 2020 election. And so the prospect of a Sanders versus Trump election became really real just in the last few weeks with some key wins out of primary states for Sanders. And so I think the market really started to wrestle with that becoming a reality. It was very much an underappreciated risk from our perspective. And so to the extent that Biden had this really strong win and resurgence and strength last night, with basically taking the South and the big win in Texas, of course the markets are going to breathe a collective sigh of relief. If you think about Trump versus Sanders, that's a really, really polarizing election season. We have two candidates at the opposite ends of the spectrum. And last time I checked, you can't, average the two and get to a moderate outcome. So markets hate uncertainty. And I think this just really injected a lot of uncertainty into the equation.
And I guess, and Amanda, I don't want to make you...
How do you price this outcome?
I don't want to make you a political analyst because these days nobody wants that, I'm sure. But I will ask this. We'll ask this. First off, well, Sanders is not out. I mean, he hasn't dropped out. He's still got a lot of delegates, and there's still very much a path forward for him. So he being there still exists. But is it because Sanders at least lost a bit last night, or is it the market saying that Trump could beat Biden more, or if that Biden wins, it's not going to be that different from what we have now?
Yeah, well, it's definitely going to be a two-person sprint to the finish. So we're not counting out Sanders by any means, but kind of felt like Biden basically didn't have a shot, in the weeks or so leading up to this. And so to really come from behind at the 11th hour with the base consolidating around him was pretty significant in terms of a sentiment-related shift. I think at the end of the day, the market can very much live with a Trump versus Biden election. As you said, it's going to be more of the same out of the current administration, or in the case of Biden, just a more moderate approach to policy. And the big rally we had today in healthcare sector, very reflective of that potential outcome.
Hey, Amanda, can you weigh in a little bit on this valuation for the S&P 500 debate? Obviously last year we were just talking about it, multiple expansion. This year, the likelihood of high single digits earnings growth doesn't seem particularly likely. But even if there is just given a mulligan or there's an asterisk next to 2020 EPS, where should this market be trading, excluding politics and excluding the black swan of the coronavirus?
Well, actually, so on a forward PE basis, we've seen the S&P 500 drop a couple of multiple points just in the last few weeks. So we were at cycle highs from a forward PE valuation perspective. Frankly, we said coming into this year that is reasonable, elevated, but not extreme, given the fact that we have very low rates, very low inflation, and a cyclically improving backdrop. So earnings growth looked like it was building momentum coming into 2020. Even economic growth, and JP Morgan's global manufacturing PMI index, posted 5 months of expansion or moved into expansionary territory just recently. And so there was this really build up and potential acceleration, largely a function in our view of all the stimulus that came into the system last year. So at 19 times PE, I mean, you can't pound the table and say, oh, the market is cheap here. But we did feel like valuations were, somewhat justified based on the backdrop. Two multiple points cheaper. I mean, we'll take it. But again, we're not really in a cheap place. We're more like fairly valued, I would say, on the S&P.
Hey, man, it's Tim. Thanks for joining us. So in terms of pounding the table, clearly table pounding in the equity market today and absolutely running away from the table. In other words, people loving the bond market in a way that implies the economy's not so good. Well, who's right?
Yeah, I mean,
divergent.
I just think it's insane that we continue to see these massive flows into fixed income investments. I mean, the tailwinds, of course, we got this nice shot in the arm from an emergency rate cut yesterday, but the tailwinds from massive rate cuts over the last, 12 plus months and even spreads tightening, I think really set the stage for strong bond market performance that we just don't think is repeatable to the same degree this year. And so, as much as it pains me to say that I think the bond market is actually right at the moment, because I'm very much an equity girl at heart, I do think the bond market is telling us kind of the right story here. This is not 2008. The credit markets are not frozen. The 2-year to 10-year portion of the yield curve has steepened. Even before the Fed took action yesterday, it was already steepening. And so that to me is signaling that this is a short-term speed bump as it relates to growth. It's not a permanent impairment.
All right,
and I know you're going to say, oh, well, the 10 years at 1%, but the Fed rate cut yesterday, huge gravitational pull, and then the negative yielding debt around the globe. It's also creating a lot of distortions and kind of mucking up the signal, if you will, in terms of rates.
Well said. I couldn't have said it better, Amanda. Agati at PNC. Amanda, we'll get you back anytime. Thank you very much. And smart people reminding me that Biden won on Saturday, and so Monday may have been more likely of sort of a Biden bounce again, which by the way is interesting because we've been talking so much about the coronavirus, guys. Anybody just jump in, which leads me to think that maybe the slide that we had was more politically based than we blamed it all on Corona. Look out for Rosie because she's the queen. And I just wonder if there's more political element to the market moves.
No, look, let's be clear. We thought about this in two kind of phases. We thought about supply chain disruption. We thought the entire impact of the global integrated economy. We looked at Asia and we said, obviously, used to be in the SARS days, we could identify and we could isolate, and that this is a global economy. It's integrated. Then we adjusted the impact on the demand side of the equation. It all adds up to questioning where growth can be, and certainly, as Dan is pressing on, where can earnings be in an environment where we were arguably already facing 3 or 4 different rounds of headwinds over the last year and a half. That's what it is. And there's no question that the politics are something that have been swirling around this market for a long time, and I would have argued that they were not priced in. But it's hard for me to say that this is really all about a relief on politics when, in fact, this is all about global growth. And there's some real questions.